Hi, I'm Jimmy. In this video, we're looking at some dividend stocks that could be a great opportunity right now as the stock market is crashing. These stocks are from the Dow Jones Industrial Average. Now, about a year ago, I did a video series where we analyzed all 30 companies in the Dow Jones Industrial Average. Sure, some of that analysis is a bit out of date at this point, but I thought it could make sense to go back and update some of the research from those 30 companies, since these are 30 of the largest companies in the country, and many of them could do quite well coming out of this stock market crash. So I tried to find 3 dividend stocks from the Dow that look like they may be appealing during this particular stock market crash. Okay, so let's jump right in. So the first company is Visa, ticker symbol V. Now, this is a chart of Visa's earnings per share going back to 2013. And the green bars over here, well, these are analyst estimates. And these estimates were from not too long ago, but these are before all of the current chaos in the economy. So it's very possible that earnings per share actually shakes out to be more like that. Or perhaps things get even a bit worse and they look like that. But our question is, will profits get back on track at some point within the next few years? And I think that the answer is yes. Visa, and MasterCard for that matter, well, they're staples in the economy and they're likely to recover once spending begins again on a global basis. Now, I don't want to imply that things can't get bad for Visa during this stock market pullback. I really think that in the short term, they can get hurt since a lot of Visa's business is transactional based. And the issue with this is that since a lot of their costs are fixed, well, their profits can drop very quickly as transactions go down. So revenue drops, profits drop. But the flip side is true as well. Once transactions pick up, well, a lot of that will go straight to the profit line. And once that happens, well, it's possible that the stock recovers. It could take a bit of time, but in time, I think that Visa has a very solid business and could do very well over the long run. Now, the good news is that Visa has done a good job of consistently increasing their dividends since 2008. And this is one of the good parts about this company and all 3 companies on this dividend list is that I think that their dividends should be sustainable during this economic downturn. Generally speaking, companies don't like to cut their dividend unless they really have to. And I expect for Visa to keep their dividend at least at the current level. Okay, next up we have Johnson & Johnson, ticker symbol JNJ. Now, just like Visa, we can see that Johnson & Johnson's earnings per share have been expected to climb. Of course, now this is in question, and it's likely to decline at least in 2020. And this helps explain the drop in the stock price over the past few weeks. But one interesting aspect of Johnson & Johnson that I dug up is that much of their business shouldn't be too affected by the virus. Their pharma business, which accounted for about 51% of their revenue in 2019, well, that really shouldn't be too affected by this. And I would think that their consumer products and their medical devices and diagnostics business should do okay in the long run. So if we were to switch back to their stock chart real quick, to me, much of this drop in the stock price as the stock market has been crashing has been more, I think it's more related to the overall market and not necessarily related to the fundamentals of this company themselves. And then when we look at their dividend history, once again, they have been impressively consistent for many years. And I think that overall, this company has a decent amount of upside, and they have a few drug test trials that have been going on and some signs for potential optimism for investors in general. Okay, so right along these same lines, I was looking for another company that had solid dividends and their exposure to the virus was recoverable, let's put it that way. So next up we have Verizon, ticker symbol VZ. When we look at Verizon's earnings per share, well, we can see that some pullback in their numbers has already been accounted for with these particular projections. Broadly speaking, Verizon isn't too vulnerable to the overall virus situation at this point, although many small businesses are vulnerable right now, and that could hurt Verizon's landline business. Plus, perhaps they get hit with some of their equipment sales. But once again, as things eventually recover, I would expect for Verizon's business to strengthen once again. And this could make the recent dip in their stock price, thanks to the dip in the stock market, I think it could make it for a relatively appealing opportunity. Now, out of the companies on the Dow 30 list, Verizon has dropped less than many of the other companies, but they have dropped nonetheless. And perhaps this is the opportunity that we've been looking for. And when we switch over to their dividend per share history, well, we can see that they've been quite consistent over the past few years. And although they don't have a dividend yield as high as a stock like AT&T, they are paying a dividend yield of a bit under 5%, so they still look fairly good. And like I mentioned before, many companies don't like to cut their dividends. So I would be surprised if Verizon cut their dividend anytime soon. So if we like dividend stocks, then perhaps Verizon is one for us to consider in this particular stock market crash. Now, if we're looking for, let's say, ETFs that could provide a high dividend yield, well, I actually did a video where I looked at some of the higher paying dividend ETFs out there, and these pay a monthly dividend. There's a link right here. There's a link in the description below if you're curious. And I want to thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.